All right, guys, so good morning. And the dust settles. What a remarkable day. This is City AM front cover. So it's quite amusing. Draghi ruining Christmas as the Grinch spectacularly fails to deliver. He's getting a lot of blame in the press this morning. Blame that he has made a communication error, or he hasn't handled this well. I would probably suggest it's the press that have got this wrong, not Mario Draghi. But I think it's probably a couple of factors why they didn't deliver what they promised, or what they seemingly promised they were going to deliver. I think there's two reasons. Number one, I think this was actually a strategy, a conscious strategy by the ECB to ramp up dovish rhetoric, get markets very excited, overhyping it, and then delivering less than the overhyped market expectations, and getting market reactions that we saw. I mean, can you imagine cutting rates and short end yields rising? Can you think of a scenario where that would happen? Well, that's exactly what happened yesterday. Draghi cut rates and short end yields rose, because when you think about it, and one of the things, one notable thing about the press conference yesterday, he was very uncommittal on any questions about the future. Questions like, all right, you've cut deposit rates by 10 basis points. Is that the new lower bound, or is there room to do more? And he flatly entirely ignored that question, didn't answer it. It was as if it wasn't asked, which is very interesting. And I think there is room to cut more if they want, but I don't think he wanted to suggest that, because ultimately he got it perfect, right? He cut the deposit rate and short end yields rose. So just think about all those bonds that now have been lifted up into the available pool of assets for quantitative easing. A lot of those short-term bonds were yielding well below the deposit rate. He's now lowered the deposit rate to minus 0.3%, and the bond yields rallied. So I think he nailed it. Plus, we're going to get the Fed hike, and they want a hiking cycle underway in the US. It's exactly what they want. They need a cheap currency, and they don't have to engineer that all by themselves. They can get their friends over at the Federal Reserve to join in on that game. So I think Draghi I think he nailed it. I think he got it perfect. And I think probably the market reactions were bigger than he thought he would get. But there's another argument which isn't quite so supportive of Draghi, which is actually he wanted to do more, but in the end, the large minority on the committee prevented him from doing it. So the large German minority contingent, the hawks in the camp, prevented him from doing more. This is another argument. Maybe that's got a little bit of legs as well. But, ultimately, from a market point of view, huge disappointment. And, markets got this wrong. And that's why we've seen big moves. So, huge disappointment. And some of the moves have been spectacular. I mean, let's just kind of pick through some of these assets. I think you've got to start with the euro dollar on a daily chart here. This is just quite ridiculous candle, taking us up almost to the 110 handle. We topped out at 109.84 yesterday, pulling back now this morning, as you can see, just dipping back below the 109 handle. But that's a 3.3% move. It's a 4.5% high to low range. The high to low range is almost phenomenal, almost 500 pips, 5 handles. And it goes down as one of the biggest ever moves in the history of the euro. In fact, depends which source you go with, but Deutsche Bank have got this. Their stats say this is the third biggest move in the euro's history. Um, the FT, it depends which article you read actually, but one of them saying this is the biggest single move to the upside for this currency pair since 2009. This is the 10th, talking about the dollar, apparently this is the 10th biggest move for the dollar in history again. So, you know, the stats are phenomenal. Obviously, you can see on the chart here, it's just, and even if you go to a weekly chart, and bear in mind this all happened in one day, I guess this puts it into a little bit of perspective in that, you know, okay, we almost got down. You know, that little blip lower yesterday off the rate decision, the chaos, you know, the FT tweet that was wrong, and then, oh, they have cut rates, but oh, hang on a minute, it's only 10 basis points, and the carnage that was created. But the low of the day there, I can just, hang on a sec. The low of the day, well, it depends. My chart was 104.98. But anyway, the point is we pretty much tested the 2015 low off the chaos that ensued around just before and just after that rate decision. Well, then we've launched up to the 110 handle, and you know, for now that's enough. We're going to quickly today, of course. Let me just roughly draw a line at 110. It's not quite there, but you see what I mean. Now this is only puts us back to mid-range. You know, really we've got a range 105 to 115. That's what this currency pair has been doing for the whole year. For the whole year, we're into December here, and basically it's been a 105 to 115 story, with one notable exception in the big blowout end of August, sort of Black Monday China-led chaos. That's the only very brief occasion we've traded outside that range, and we're still, not only are we in the range still, we're actually bang in the middle of it. So let's get this in perspective. Yeah, one of the biggest moves in history, but actually we're still right down here at the bottom. So Europe, they get their cheap currency still, and I think they ensure a cheap, you know, you're not going to get the euro dollar rallying to 115 here. And that's, well, there is a chance that could happen. The only way the euro dollar gets up to the top of this range is if the Fed don't hike. Now, I think the chances of no hike, well, markets are pricing in the chances of no hike at around about sort of 20-25%. I think it's a lot lower than that. I'd say the chances of no hike are like less than 5%. You're going to need the worst non-farm payrolls number in recent memory today for the Fed to start thinking, hang on, we're going to have to wait. So we'll talk about the payrolls number in a second. But, you know, we're back to the 110 handle. It's mid-range, and we'll see what we get. In order to get back to 105, though, if we just go to a daily chart, can we get back to 105? What happens if the Fed hike in December? Can we get back to 105? And I think actually I think all we're going to get is a continuation of this 105 to 115 range for the foreseeable future. I think the only way you get back to 105 by Christmas is if it'll take more than a Fed hike to get us to 105. Because the Fed hike is almost fully priced in. What you're going to need is not only a hike on December the 16th, but also guidance that the second hike will be in March 2016. Currently, markets are pricing in hike number 2 in June of next year. So they're pricing in a speed of 1 25 basis point hike per 6 months. But if the Fed communicate on December the 16th that it's going to be more like 1 hike per quarter, well then sure, we're back at 105. I think that's definitely right. But whether that happens or not, maybe it will depend on this payrolls number today. But we've had bad data this week from the US. The ISM numbers have been really bad, which means that perhaps the Fed are going to have to be more cautious. I don't mean not hike. I think they'll hike, but I think they'll be more cautious about their guidance going forwards. They'll be like 1 hike and look, let's just see. And in which case, we're not going back to 105. And I think we're locked in the middle part of this range as we go into quarter 1. So we'll see about that. But look, quickly around the other markets off the back of Draghi. I mean, monster moves. Let's just look at the DAX, for example, on a daily chart. bounced a little bit into the close. So in the end, finished 2.6% down. It was well over 3% down at one point. Euro stocks, very technically nice and neat when that we traded aggressively down, of course, and tested the November low and then bounced. For Euro stocks, the percentage moves was 2.5% down. This is futures, of course. The cash markets were down more than this. We did get a little bit of bounce after cash market hours. So obviously stocks got hammered. Even the S&P got taken down. Biggest down move for the S&P since August. And I think this is looking quite nice now from a confirmation of this downward trend we've been talking about for many weeks now. Nice top at 2100, big reversal lower. I've got a bit of a trend line on here. There's only kind of 2 reference points to it, but this is S&P down on the year yet again. It's been a bit of a yo-yo year around about the opening price, but actually here's the yearly chart. Actually, we're not down on the year. Hang on. Let me just, we're actually officially up on the year by 5 points. We are 20 ticks up on the year as we head into December. So that looks like a nice little doji reversal signal, doesn't it? Mind you, we had a doji reversal signal in 2011 and that couldn't have been more wrong. So anyway, but yeah, I think quite a nice confirmation that we're still in this downtrend. I think if you get the Fed hiking, then great. I think we're down to 2000 by year end, especially if the Fed guide that we're going to get a hike in March. So stocks got hammered. Bonds, remarkable day for bonds. I mean, huge movement. Again, multi-year moves that we haven't seen for multiple years. So yields across the spectrum collapsed. It didn't. Yields across the spectrum went up. Prices collapsed, as you can see here on the Bund. A full 350 ticks to the downside, and so one of the great memorable days for markets. It'll go down in history. We'll be talking about this day for years. But we move on now. What do we do after it? And the amazing thing about this week is we've got to very quickly switch our attention to now the next most important thing, which is of course today's non-farm payrolls numbers. So let's have a quick look at the calendar. Hang on, let me get the right screenshot in here. Let's have a look at the calendar for today. Data calendar. The lineup and quiet this morning. We've had some factory orders out of Germany earlier on that were so this was delivered at 7 a.m. as you can see on that timetable, and this came in better than expected, although negative on an annualized basis. But month on month it was plus 1.8% above the 1.2% expected. Annualized though is minus 1.4, but still better than the minus 2.5% that we had expected. So better than expected German numbers. We've had some OPEC comments. I'll talk about OPEC in a sec, but I'm just looking at my headline feed. OPEC delegate says there is a small probability that they will make any other decision than maintaining. It's a very odd sentence to write. Small probability that they will make any other decision than maintaining. Not quite sure who's in charge of writing that headline feed, but actually quite sure what that means. Anyway, they're not gonna cut production. I hope that's what it means. If it means something else, they're wrong. Now, let's talk about the rest of the morning. It does look on here. Look, we've got these retail PMI things, which on the face of it looks like they might be interesting, but they're not really. These aren't market sensitive. So you can by and large ignore them. This morning's about trying to further digest the remarkable events from yesterday, and so we've had bounces, we've had some small mild reversals, but I think markets are in turmoil. They're in a state of shock. I don't think they quite know what to do with themselves, but that's fine because we're going to get a completely new and different guide this afternoon. And so this is in the shape of the payrolls number. And of course, coming up 1:30, current forecast 200,000. The unemployment rate is expected to stay unchanged at 5%. What will be really interesting, as always, the average hourly earnings numbers to get a read on wage growth. We had a really strong number on this last month at plus 0.4%. The annualized number came in at plus 2.5%, which was the highest or the fastest rate of annualized wage growth for a few years. You know, all of the last month's report with payrolls at 271, it was just one of those phenomenal reports that every single element of it came in very strong. There was no conflict. It was straightforward, out and out, phenomenal news about the labour market. Now, can we repeat it today? And we got a 200 forecast. Now, I think, Deutsche Bank's, well, I hesitate to use Deutsche Bank's thought process on non-farm payrolls. I hesitate because Deutsche Bank's thought process on the ECB couldn't have been more wrong. But Deutsche Bank have got quite a good angle on this. I read this morning as well, and they're looking back at, they're looking at two things. Firstly, the labour market data this week about November. So the ISM numbers have been really bad. Both of them, the manufacturing and the non-manufacturing numbers have been really bad. The ADP number was fine, decent, but the ADP number was a rubbish guide last month. The jobless claims have remained very strong. So you've got a mixed bag, but the ISMs have certainly deteriorated. Okay, so on that front, you could say, well, today's payrolls number is going to be disappointing. Secondly, given the number that we got last month at 271,000, surely wasn't that October stealing some job creation from November? And aren't we going to get a pullback now to offset that? And there's an argument looking at the retail sales figures, actually. Apparently, Deutsche Bank were talking about this, and they're talking about an early ramp up in holiday hiring on the part of retailers. Retailers hiring in October rather than the normal traditional sort of seasonal hiring in November. And this does get confirmed when you look at retail sales data for October, which was phenomenally strong. So there is an argument here to say that October's number was so strong and it's going to be at the expense of November, where we're going to get a weak number. Deutsche Bank are calling for a 150 today. Also, if you look back at the pattern of December, and we'll look at this more later on before the news, but if you look back at December 2014, we got a 255 print, really strong, and we had this same pattern, really strong retail holiday hiring. And then in January, we dropped off sharply. So there's a risk here that we're going to get a disappointment on payrolls. How big the disappointment is, I don't know. If it comes in below, I think it needs to be below 100 for the Fed to properly look at it and question whether they're doing the right thing in raising rates. I think it needs to be below 100. I really do. I think anything above 100, and I think they'll hike. So this is coming this afternoon. This will be the big event, obviously. Beyond that, we got the OPEC meeting. Just before we talk about OPEC, just a few charts. Look, here's last month's payrolls figure, giant leap, biggest number of the whole year. This could get revised, of course. It will get revised. Which way it goes. You'd think at the size of this number, you'd say, well, most likely if it's going to get revised, it'll get revised down. But we have seen upward revisions of really big numbers in the past, so there is scope for it to be revised up. So this is the payrolls chart. I'm worried we're going to get a drop-off. We'll talk much more about this later. Here's the unemployment rate, expected to stay at the new post-crisis low of 5% that we hit in October. This is fine. I think ignore this. It's not important. It could drop below 5%, but you know what? It doesn't make much difference. This is the Fed, as far as the unemployment rate are concerned, they're absolutely ready to go to raise rates. If all they looked at was the unemployment rate, they'd be raising rates. This is the average hourly earnings chart, and we've had a decent run of it this year. And I know it's volatile. We had a couple of zeros in here, but we've had a couple of plus 4.4% reads in the last 3 months, which means that the annualized reading is now up to the highest it's been for a few years. So much more on this later. But just on OPEC, the meeting is today. The official press conference is timed at 3 p.m. But we're going to get. You never wait till the official press conference with an OPEC meeting to hear the news. We'll get it. It's kind of already been. The news has already been effectively released in my mind. The Saudis aren't going to be willing to cut production. They're up for it, but only if the Russians will do the same. And Russia have already said this week they're not willing to do that. We had a meeting that was organized. Don't think that Russia meeting organized for earlier on this week. Don't think the timing of that was just coincidental. That meeting was planned so that Saudi could do a deal with Russia before then the OPEC meeting where they could officially cut production. That Russia meeting's now been pushed back till later in the month. Russia aren't keen to cut production. Saudi aren't going to do it either. I mean, if they cut production, they're just all that will happen is they lose more market share. That's it. And they don't want to lose market share. The whole strategy they have is to win market share back. So you're not going to get a production cut. We did get a lift in crude oil yesterday afternoon. This was an FX-related thing, though, with the dollar weakening, as a result of euro strength. But it was dollar weakness, which ultimately helped the commodity space. We lifted higher. But looking on a daily chart for crude, when we get confirmation there's no production cut, it's priced in, I think. I don't think you're necessarily going to get a big blowout move below $40. It's priced in. So I think the OPEC, now that we're here, I think it's not really going to be much of an event. You might get a very short-term move off a headline. So be aware there will be headline risk throughout the morning and into the afternoon. OPEC delegates making comments before the official meeting and the official press conference. Okay, so now that we're here, I think this OPEC event is it's a much less traumatic event than it could have been, I would say. Right, so let's get on with it. The big, again, like yesterday, keep your powder dry. The main event is this afternoon. I just switched to some 1 hour charts. It's kind of crazy, the ranges we've got. And it's always difficult trading a consolidation of a massive move. We've got the S&P resistance at the pivot at this point. We've got the DAX resistance at 10,800. We've got the euro dollar pulling back, some kind of support around this fib level. Get your fib levels out, but I would be very, be cautious. Some of these ranges are just so ridiculously large. It's so hard to trade the morning after of a massive event. It's so hard to trade consolidation when there isn't yet a defined range for it. So just take it easy this morning and keep your powder dry for the main event, which is payrolls at 1:30. All right, enjoy the session.